$6 trillion gone in 60 minutes. If you bought at the top, you just became exit liquidity for someone else. Silver crashed from $121 to $108. Gold dumped from $5,600 to $500. And most investors have no idea why. Right now, somewhere, someone is staring at liquidation alerts, watching their portfolio bleed. The mainstream financial media will tell you it's just volatility. They're lying. What happened today wasn't random. It wasn't unexplainable. And if you don't understand the hidden force behind this crash, you will get destroyed by the next one. But here's what they won't tell you. Well, I've seen this exact pattern before. Not months ago, weeks ago. And what happened next changed everything. By the end of this analysis, you'll know exactly what institution-level players saw, that retail investors completely missed. But first, welcome to John Analyst, where we cut through the financial noise and show you what's actually happening in markets while everyone else is distracted. If you've been investing for a few decades, you know the game has changed. The old rules don't apply anymore. So here's what I'd ask of you, as one seasoned observer to another. Hit that subscribe button right now. Not because I need the numbers, but because what we're about to examine could save your portfolio from the next market structure event. And before we begin this analysis, drop a comment below and tell me, where in the world are you watching this from? New York, London, Singapore, Mumbai? I read every single comment, and your location matters because this crash affected different time zones differently. Now, let's examine exactly what happened. Today is January 29th, 2026, at approximately 10:30 a.m. Eastern Time. Gold was trading at $5,600 per ounce. Silver sat at $121. 60 minutes later, the landscape had completely transformed. Gold had collapsed to $500. Silver had crashed to $180. $500 wiped off gold. $13 erased from silver in the time it takes to attend a single business meeting. Let me put this in perspective for serious investors. If you held $100,000 in silver at the top, you now had $89,000, $11,000 vanished, not over weeks, not over days, in 1 hour. If you were operating with leverage, if you were using margin, if you had call options expiring this week, the outcome was far worse. This wasn't just price movement. This was a liquidation cascade. And understanding the mechanics of what occurred is critical for anyone managing significant capital in these markets. When price drops with extreme velocity, leverage traders receive margin calls. They must sell immediately. Their selling pushes price lower. That triggers additional margin calls. More forced selling, more liquidations. It becomes a waterfall effect. Each wave of selling triggers the next wave. The system feeds on itself. And the participants who purchased at the top, those who saw gold at $5,600 and silver at $121 and projected continued upward momentum, they just experienced what institutional traders call getting caught in the machinery. Now, here's what the financial media won't explain to you. This crash did not emerge from nowhere. There were warning signs, clear signals that something was about to fracture. But most retail investors never saw them. And let me be direct about something that matters. This crash was not an accident. Market events of this magnitude never are. Somewhere, institutional players with access to information streams that retail will never see, they knew this was coming. They saw the Federal Reserve signals before the headlines appeared. They saw the China manufacturing data before official release. They positioned themselves before the crash materialized. And when it happened, they were ready. They were on the correct side of the trade. They were the ones purchasing your panic sales. This is how capital markets function at the institutional level. They have always functioned this way. The question is whether you want to continue being on the wrong side of these transfers, or start understanding the actual mechanics. But before we examine what caused this event, you need to understand something that will change how you view precious metals forever. Gold and silver did not crash because something fundamental changed with gold and silver. They crashed because of something else entirely. And that something has a specific name, the DXY. If you don't know what the DXY is, pay extremely close attention, because this might be the most valuable information you acquire today. And I can guarantee that 90% of retail investors have never even heard of it. The DXY stands for the dollar index. It measures the strength of the US dollar against a basket of 6 major currencies: euro, yen, pound, Swiss franc, Canadian dollar, Swedish krona. When the DXY rises, the dollar is strengthening relative to these currencies. When the DXY falls, the dollar is weakening. Now, here's the critical relationship that professional traders watch constantly. Gold and silver move inverse to the dollar. They are inversely correlated. Not sometimes, not occasionally. Almost always. Let me explain this in practical terms. Gold and silver are priced in dollars. When the dollar strengthens, it takes fewer dollars to purchase the same amount of gold, so the price in dollars decreases. When the dollar weakens, it takes more dollars to purchase the same amount of gold, so the price in dollars increases. Think of it as a seesaw mechanism. The dollar sits on one side, gold and silver sit on the other. When the dollar side rises, the gold and silver side falls. When the dollar side falls, the gold and silver side rises. They cannot both be elevated simultaneously. The mechanical relationship doesn't function that way. This is why professional institutional traders don't just monitor gold and silver charts. They watch the dollar, they watch the DXY, because the DXY tells you what gold and silver are about to do before they do it. Today, the DXY surged hard. The dollar strengthened dramatically against other currencies. The dollar side of the seesaw went up, and gold and silver, they got crushed. The other side went down. This is not complicated. This is not conspiracy. This is not manipulation. This is basic market mechanics that most retail investors completely ignore. They watch gold, they watch silver, they monitor the charts continuously, but they never watch the dollar. And then they express surprise when this happens. They call it manipulation. They call it unfair. They don't understand they were watching the wrong indicator. If you learn nothing else from this analysis, learn this. Watch the DXY. When the dollar spikes, prepare for downward pressure in metals. When the dollar drops, prepare for gains. Most retail investors have no idea this relationship exists. They purchase gold and silver without ever examining the dollar. And then they wonder why they keep getting stopped out, why they keep buying at incorrect times, why the market seems structured against them. It's not structured against them. They're simply watching the wrong thing. The professionals, the institutions, the hedge funds managing billions, they watch the DXY like predators watch prey. They see the dollar spiking, and they dump metals before retail investors even register what's happening. By the time you see the red candle forming on your gold chart, they've already exited their positions. You become what's called, in institutional circles, exit liquidity. Today, you became exit liquidity for someone else, unless you understand what I'm about to show you. Now let me explain why the dollar surged today, because understanding the why helps you predict the next move. There are three forces that converged simultaneously, three catalysts that aligned at the exact same moment, and each one is critical to understanding the complete picture. Miss any of these, and you won't see the next event coming. Catalyst number one, the Federal Reserve. The Fed has been transmitting hawkish signals. For those unfamiliar with central bank terminology, hawkish means they're leaning toward maintaining elevated interest rates, or potentially raising them further. Dovish means they want to cut rates. Right now, the Fed is hawkish, very hawkish. And here's why that matters for the dollar. Higher interest rates make the dollar more attractive to foreign institutional capital. Why? Because when rates are elevated, you earn superior returns by holding dollars, you get better yields on treasury bonds, you get enhanced returns on dollar-denominated assets. So what do foreign investors do? They buy dollars, they convert their euros, their yen, their pounds into dollars to capture those higher yields. More demand for dollars means dollar price rises, DXY increases, and when DXY increases, you already know, gold and silver decline. The Fed has not cut rates as aggressively as market participants expected this year. Everyone projected they would cut substantially. They didn't. They're concerned about inflation returning. They're communicating a firm stance. They're signaling rates might remain higher for an extended period. And the market is listening. The market always listens to the Federal Reserve. This is catalyst number one. The Fed is hawkish. Dollar is strong. Metals are weak. Catalyst number two, China. This one is specifically damaging for silver. Pay close attention if you hold silver positions. China's industrial activity is decelerating. The latest manufacturing data shows contraction, factory output declining, economic momentum fading. Now, why does this specifically impact silver? Remember what distinguishes silver from gold? Silver is not purely a precious metal. It's an industrial metal. More than 50% of silver demand originates from industrial applications. Solar panels. Every single unit requires silver. Electronics. Your smartphone contains silver. Your laptop contains silver. Electric vehicles. Every EV uses substantially more silver than conventional automobiles. Semiconductors, AI chips, data centers, all require silver. And where's the majority of this manufacturing concentrated? China. When China slows down, industrial demand concerns intensify. Traders begin calculating. Maybe silver demand will contract. Maybe fewer solar panels will be manufactured. Maybe fewer electronics. Maybe less silver will be required. Fear enters the market. Selling begins, and silver being more volatile than gold, being more connected to industrial demand, crashes harder than gold. This is precisely why silver dropped 11% while gold dropped 9%. The China news impacted silver more severely because silver carries industrial exposure that gold doesn't. This is catalyst number 2. China is slowing. Industrial demand fears are rising. Silver is getting hit disproportionately. And I wish I could tell you that's the extent of the damage. But it gets worse. Catalyst number 3, the U.S. government shutdown, January 31st. 2 days from now, the U.S. government is approaching a shutdown if Congress fails to pass funding legislation. Shutdowns have occurred before. They're typically temporary. They usually get resolved. But markets despise uncertainty. Markets despise political chaos. When uncertainty emerges, traders reduce risk exposure. They take profits. They move to the sidelines. They sell first and analyze later. After the massive rally we experienced this month, there was substantial profit sitting on the table. Gold up 30%, silver up 65%. Investors were sitting on enormous gains. Many of those investors were seeking an excuse to take profits, looking for a reason to sell portions of their position, lock in some gains. The shutdown fears provided that excuse. It wasn't the sole reason, but it was the trigger, the justification that allowed profit-taking to accelerate. This is catalyst number 3. Political uncertainty, profit-taking, risk reduction. 3 forces converging at the identical moment. Fed hawkish, China slowing, shutdown looming. Each one independently might have caused a minor correction, all 3 together, all 3 impacting simultaneously. Result? More than $6 trillion evaporated in 60 minutes. Now, let me show you something most investors fundamentally misunderstand, the relationship between gold and silver. Many people assume gold and silver move together, same direction, same intensity. That assumption is dangerously incorrect. Yes, they move in the same direction, but not with the same intensity. Silver is gold on steroids. When gold moves 5%, silver moves 10 to 12%, same direction, but with double the force. Gold rises 10%, silver rises 20%, gold crashes 8%, silver crashes 15 to 20%. Examine what happened today. Gold dropped approximately 9% from $5,600 to $500. Silver dropped nearly 11% from $121 to $108. This is not coincidence. This is the silver amplification effect. Gold leads, silver follows, but silver follows with magnified intensity. This is why silver generated 65% gains this month, while gold generated 30%. And this is why silver crashed harder today. If you're trading silver, you must understand this fundamental dynamic. Silver will build wealth faster, but it will also destroy capital faster. The leverage operates in both directions. Now, examine Monday's crash. Just days ago, Monday was different. On Monday, silver crashed 14%, but gold only dropped 2%. Why? Because Monday's crash was silver-specific. It was driven by industrial demand concerns, China news, silver-specific selling. Today's crash is different. Today, both gold and silver crashed together. Gold down 9%, silver down 11%. When both crash together like this, it reveals the cause is different. It's not silver-specific. It's a macro cause. In today's macro cause, the dollar. The DXY surged, both metals dumped. This distinction is critical because it tells you what to monitor. If you want to predict the next crash, watch the dollar. Not just gold, not just silver, the dollar. When the DXY spikes, prepare for pain. Now, here's where this analysis becomes extremely interesting. And this is the section you need to pay absolute attention to. Because I've witnessed this exact pattern before. Not years ago, not months ago, weeks ago. December 2025, the final 2 trading days of the year. December 30th and 31st. The same thing occurred. Almost identical setup. Sharp crash materializing out of nowhere. Panic selling cascading through every market. Liquidations stacking on top of liquidations. Red candles forming continuously. Weak hands getting completely destroyed. The sentiment was absolutely catastrophic. Social media platforms filled with doom predictions. Analysts calling for the end of the bull market. The rally is finished. Gold and silver are done. The top is in. Fear was maximized. Despair dominated every conversation. And then, January happened. January 2026. This month, the month we're currently completing, gold rose 30% in a single month. Silver surged 65% in a single month. Record highs weren't just reached, they were shattered. The largest monthly rally in over 4 decades. All those participants who panicked in December, who sold at the bottom because they were terrified, who listened to the doom predictions. They watched the rocket launch without them on board. They sold low. They missed everything. Now observe today's date, January 29th, 2 days before the end of the month. Sharp crash, panic selling, liquidations cascading. Same pattern, same timing, same fear. The question that matters now, will February repeat what January did? Will we witness another massive surge? Let me show you why the probability might be higher than most analysts realize. First, understand what has not changed. This is absolutely critical. The crash today was about the dollar, about the Fed, about short-term fear, about inexperienced hands getting shaken out, but the fundamentals, the big picture, the factors that actually drive long-term value, none of that changed. Not one element. While you were watching your portfolio decline, Tether was still purchasing 1 to 2 tons of gold every single week. They didn't stop because of a 60-minute crash. They don't react to your fear. They are accumulating systematically. While you were monitoring red candles form, BRICS nations were still stacking physical metal. China, Russia, India. They didn't sell today. They bought. They always purchase the dips. They've been executing this strategy for years. While you were refreshing your portfolio repeatedly, the de-dollarization trend was still accelerating. Countries are still moving away from dollar dependence. That didn't reverse in 60 minutes. While you were questioning your entire investment thesis, the supply deficit in silver remained unchanged. 5 consecutive years of deficit. Mines continue depleting. That fundamental reality didn't change today. You know what changed today? Sentiment. That's it. Just sentiment. Weak hands panicked, strong hands accumulated, and sentiment. Sentiment can reverse instantly. It flipped negative today. It can flip positive tomorrow. Second, examine what happens after sharp crashes in bull markets. In genuine bull markets, crashes are accumulation opportunities. They shake out weak participants. They reset overbought technical conditions. They create fear. And then the institutional players step in. They purchase the fear. They accumulate at discounted prices. They load positions while retail is panicking. Then the rally resumes, stronger than before. This has occurred repeatedly throughout this bull market. The question becomes, are we still in a bull market? Examine the evidence objectively. Gold is still elevated substantially on the year, even after today's crash. Silver is still up massively. Even after today's decline, central banks are still buying. Record purchases continue. The dollar's long-term trend remains downward. Today was a spike, not a trend reversal. Nothing in the data suggests the bull market has terminated. Everything suggests this is a correction within a larger uptrend, but I could be incorrect. And I know what some of you are thinking right now. Here we go again. Another analyst telling me to hold through the pain. Another voice saying, buy the dip. I've heard this before. I understand. I genuinely do. You're exhausted. You're concerned. You just witnessed your portfolio drop double digits in an hour. The last thing you want is someone telling you to remain calm. But here's the distinction. I'm not telling you what to do. I'm showing you the data. I'm showing you the patterns. I'm showing you what has occurred before in identical situations. What you do with that information is your decision. I'm simply ensuring you have all the facts before you make that decision. That's why I want to present you with 3 scenarios. And then I'm going to give you a specific prediction on the record. Scenario 1. The bull continues. This crash is exactly like December. A shakeout before the next leg upward. February starts strong. New highs by March. Silver breaks $150. Gold breaks $6,000. Probability. I assess at 60%. Scenario 2. More pain approaching. The Fed becomes more hawkish. Dollar continues rising. China data deteriorates further. We witness another crash. Gold tests $4,800. Silver tests $90. Probability. I assess at 30%. Scenario 3, the consolidation zone. We move sideways. No new highs. No major crash. Just choppy, frustrating price action for weeks. Traders become bored. Retail gives up. Then the move comes when nobody expects it. Probability. I assess at 10%. Now, here's my specific prediction. The one I mentioned at the beginning. Silver will trade back above $120 by February 15th. Not by March, not by summer. By February 15th, 17 days from now. Here's the reasoning. This crash brought silver from $121 to $108, $13 down. That's substantial in 60 minutes. But it's minimal compared to the rally we just experienced. The pattern from December indicates we bounce. The fundamentals indicate we bounce. The oversold technical conditions indicate we bounce. And February 15th, that's when the shutdown situation will be resolved one way or another. That's when the fear subsides. That's when institutional buyers returned. $120. February 15th. On the record, which scenario do you think materializes? Now let me provide you with practical strategic guidance, because knowing what happened is completely useless if you don't know what to do about it. If you're holding physical gold and silver, my assessment is straightforward. Do nothing. Physical metal is not a trading vehicle. It's not something you buy and sell based on daily price movements. Physical metal is insurance. It's long-term wealth preservation. It's a strategic hedge against systemic currency degradation. You don't liquidate your insurance policy because the stock market had a volatile day. You don't withdraw your retirement savings because there was a market correction. Physical metal operates under the same principle. You don't have a loss until you sell. Until you sell, it's simply a number on a screen. It doesn't affect your actual financial position. It doesn't change how many ounces you own. If you purchased physical silver at $100 per ounce, you still own that silver. It's still in your possession. The crash didn't remove it from you. Ignore the daily volatility. Return in 6 months. Return in a year. The fundamentals have not changed. The long-term thesis has not changed. Only the short-term price fluctuated. If you're trading with leverage, today was your definitive warning signal. Leverage in volatile markets is a guaranteed path to account destruction. Not might be, not possibly, is. Liquidations, triggering liquidations. That phrase should concern you deeply because that's exactly what occurs when leveraged traders get trapped on the wrong side. You believe you're sophisticated. You believe you can manage the volatility. You believe your stop loss will protect you. And then price gaps down. Your stop loss gets bypassed. You get liquidated at a price far worse than you anticipated. Your account is gone. This happens every single time there's a sharp crash. Leveraged traders get completely wiped out. Every single time. If you're using leverage on gold or silver, reduce it dramatically or eliminate it entirely. The potential gains are not worth the risk of total capital destruction. If you're waiting on the sidelines with cash, this might be your strategic moment. The optimal time to accumulate is when there's blood in the streets, when fear dominates everywhere, when people are panicking, when red candles are forming continuously. That's when intelligent capital accumulates. That's when the wealth transfer occurs, from the panicked to the patient, from the fearful to the prepared. But only deploy capital you can afford to hold through additional volatility, because I cannot guarantee this is the bottom. There might be more downward pressure. There might be another leg down. Purchase in tranches. Don't deploy everything at once. Buy some now. If it drops further, buy more. Average into your position systematically. And only use capital you can afford to lock up for months or years, not money you require next week. If you bought at the very top, if you purchased silver at $121 or gold at $5,600, I'm not going to provide false reassurance. It's painful. Watching your portfolio decline 11% in an hour is genuinely painful. I understand. But you have two choices right now. Choice 1, panic sell at the bottom and crystallize your loss. Make the loss permanent. Transfer your wealth to whoever is purchasing from you right now. Choice 2, maintain your position through the volatility and wait for recovery. Accept that you bought at suboptimal timing. But recognize that poor timing is not equivalent to a flawed investment thesis. If the fundamentals remain solid, if the long-term thesis remains intact, then your only error was timing, and timing errors get corrected over time. History rewards the patient, but you must be able to withstand the drawdown psychologically. You must be able to observe red without panicking. You must be able to hold when everyone else is selling. Can you do that? Only you know the answer. Now, let me address something important. Some of you are genuinely concerned right now. You're watching your portfolio and feeling physically ill. You're questioning whether you made a fundamental mistake. Let me provide perspective. In 2020, gold crashed 30% in March. People panicked. They sold. They declared gold was finished. By August, gold reached all-time highs. In 2008, silver crashed 50%. People said silver would never recover. 3 years later, silver hit $50. Every single bull market contains corrections. Every single one. The question is not whether corrections happen. They always happen. The question is, do you possess the conviction to hold through them? That conviction originates from understanding. If you understand why gold and silver are rising long-term, you can endure the short-term pain. If you don't understand, every crash will shake you out. You'll buy high and sell low repeatedly. This is why I create these analyses, not to tell you what to purchase, but to help you understand what's happening so you can make informed decisions independently. Now, let me tell you what I'm monitoring. Number 1, the DXY. If the dollar continues surging, more pain for metals. If the dollar reverses, metals will bounce aggressively. Number 2, February 1st, the day after the shutdown deadline. What happens in the first few days of February will reveal substantial information. Number 3, China data. Any indications of stimulus or recovery will be bullish for silver. Additional negative data will be bearish. Number 4, Federal Reserve speakers. What they communicate this week matters significantly. Hawkish commentary means dollar strength. Dovish commentary means metals rally. Monitor these 4 indicators. They will tell you what materializes next. Now, there are 3 types of people watching this analysis right now. The first type is panicking. They're refreshing their portfolio every 5 minutes. They're considering selling everything. They're allowing fear to drive their decisions. The second type is frozen. They don't know what to do, so they do nothing. They just observe and hope it improves. The third type is learning. They're taking notes. They're understanding why this occurred. They're preparing for what comes next. They know that crashes create opportunities for those who are prepared. Which type are you? Let me leave you with this final observation. Markets are structured to transfer wealth from the impatient to the patient, from the emotional to the rational, from those who react to those who prepare. Today, $6 trillion changed ownership in 60 minutes. Some people lost that capital. Other people acquired it. The question is, which side of that transfer were you on? If you panic sold today, you transferred your wealth to someone else, someone who was waiting for this, someone who understood the mechanics. If you're still holding, you still have an opportunity. The situation is not concluded. And if you're positioned in cash, observing from the sidelines, waiting for your moment, pay attention. Because moments like this don't materialize frequently. December crashed, January surged, January is crashing, February is approaching. The pattern is evident. Will it repeat? The crash happened. You cannot change that. No amount of wishing will restore those prices. What you can change is what you do next. What you can control is your response. Will you panic and make it worse? Will you freeze and do nothing? Or will you learn and prepare? The market doesn't care about your feelings. The market doesn't care that you're concerned. The market doesn't care that you bought at the top. The market only rewards those who understand it, those who prepare for moments like this, those who have a strategy before the crash materializes. If you didn't have a plan entering today, now is the time to construct one. What will you do if we crash another 10%? What will you do if we rally 20%? What is your strategy? Because there will be another crash, and another rally, and another crash after that. This is how markets function. This is how they've always functioned. This is how they will always function. The question is not whether volatility will occur. The question is whether you will be prepared for it. I've been analyzing these markets for years. I've witnessed crashes. I've witnessed rallies. I've seen people build fortunes. And I've seen people lose everything. The difference is never intelligence. Highly intelligent people destroy their accounts constantly. The difference is preparation, emotional control, having a strategy, executing the strategy. Today tested everyone. Today separated the prepared from the unprepared. Today revealed who you actually are as an investor. Did you appreciate what you saw? This is John Analyst, where the real story is never on the surface. We'll post an update soon examining how this develops. I'll see you in the next analysis. We'll discover together who was correct. Until then, stay calm, stay prepared. And remember, $6 trillion changed ownership today. Make certain next time you're on the correct side of that transfer.